Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Rezolve AI.
If you find our talks useful, please consider subscribe, like, and comment underneath. So let's look at the calendar. It's Sunday, February 15th, 2026.
We're midway through the first quarter and the market is, it's doing its usual thing. Can't decide if it wants to party or panic.
Exactly. But amidst all that noise, we have a specific situation today that I've been really itching to talk about.
Oh, it really is a fascinating one, isn't it? We're looking at a company in what they call the agentic commerce space.
And usually when we talk about AI and commerce in the same sentence, we're talking about these huge, expensive valuations, right?
Massive hype trains and companies that are just burning cash like it's firewood. But this story is different.
It is. The numbers are confusing people, I think. We have this massive divergence right now. It's one of those setups that makes you really squint at your screen.
It really does.
On one hand, you have the share price, which has been beaten up recently. It's sitting around, what, $2.59?
$2.59. Looks like it's in the penalty box.
But on the other hand, you have analyst targets that are just, multiples higher than that.
Right, and usually when you see a gap that wide, it means the analysts are just slow to downgrade. But that's not what's happening here.
Not at all. And then just this past week, we had a 9-figure acquisition. And here's the kicker, the part that I had to read twice to believe they didn't dilute shareholders to do it.
That is the headline for me. When a company at this market cap, roughly $1.3 billion, spends over $200 million.
You expect dilution.
You expect a massive share offering, you expect debt, you expect the stock price to plummet because the pie is getting sliced into thinner and thinner pieces. And that didn't happen here.
So let's unpack this. We need to figure out if this is a classic value trap where the price is low for a very good reason, or if the market is just completely asleep at the wheel.
And offering us a mispriced asset.
Let's start with the growth engine. We've essentially just closed the books on 2025.
Yeah.
How did they look coming out of last year?
They exited 2025 with some significant momentum. If you look at their annual recurring revenue, their ARR, they hit approximately $209 million.
Okay, that's a solid base.
It's a very solid base for a company this size. But the really telling metric, the one that signals the inflection point, was December.
Why December specifically? Was it just holiday seasonality kicking in?
It was more than that. In December 2025 alone, their revenue was over $17 million. And that marked the company's first profitable month.
Hi, wow.
For the full year 2025, revenue hit at least $40 million. So they crossed that profitability threshold right at the end of the year. It proves the unit economics actually work.
So it's not just growth at all costs anymore. It's growth with discipline.
Exactly.
Okay, so they are profitable as of December. That is a huge milestone for any high-growth tech stock. Usually we're looking at these AI companies and saying, oh, okay, they'll be profitable in 2029, maybe, but Rezolve is there now. However, then we got the guidance for 2026. And I have to be honest, when I first saw it, I thought it was a typo.
It does look aggressive on paper, doesn't it?
Aggressive. Well, it's bordering on sci-fi. They are guiding for $350 million in revenue for 2026. They just did over $40 million in 2025.
It's nearly 10x growth in a single year.
That is bold. In the SaaS world, if you grow 50%, you're a hero. If you grow 100%, you're a unicorn. 1,000%. Is that even realistic, or are they just dreaming?
It is incredibly ambitious, yes. And they're also targeting an exit 2026 ARR of at least $500 million.
Wow.
But here's the thing. It's not just wishful thinking put on a PowerPoint slide. They have the operational metrics to back up why they think they can hit this ramp. It's all about the latent demand in their pipeline.
Okay, give me the evidence. Because 10x growth is something you usually only see in slide decks right before a company implodes. Walk me through the math.
It comes down to the pipeline and the usage volume. They currently have over 650 enterprise customers. That's a strong roster.
It is.
But look at the volume, over 51 billion API calls and more than 340 million unique users.
51 billion.
51 billion. Think of API calls as, digital foot traffic. If you own a store and 51 billion people walk past the window, you're going to sell some merchandise.
Right.
That volume is the leading indicator of revenue. When you have that much activity on the platform, the monetization, it follows. It's a funnel. Plus, they've mentioned $250 million in repeat institutional commitments.
So the demand is already contractually there.
A significant portion of it seems to be locked in, yes. That $250 million commitment gives them a lot of visibility. It's not, we hope to sell this, it's, we have buyers lined up.
That's a crucial distinction. The retail market sees 10x growth and thinks hype. The institutional market sees the contracts and thinks execution.
You've got it. And that's why they can project that $350 million figure with a straight face.
Okay, so the growth targets are massive, but there's data supporting it. Now, we have to talk about the news from last week. Between February 10th and 12th, they dropped a bombshell. The acquisition of Reward Loyalty UK.
This is the game changer for their balance sheet perception. They bought Reward Loyalty for $230 million.
And again, for the listeners in the back, how did they pay for it? Because I feel like we can't stress this enough.
Entirely using existing cash resources.
That is just wild. That is like walking into a luxury car dealership and buying the most expensive car on the lot with a suitcase full of cash while everyone else is filling out loan applications.
It really is. No equity dilution, no external debt financing. They just wrote the check.
So what does that do for them?
Well, two things. One, it immediately integrates a massive loyalty and engagement engine into their AI platform. But two, and maybe more importantly for us, it flexes their financial health.
A company that is struggling or cash poor cannot casually drop $230 million cash on an acquisition. It just doesn't happen.
It completely kills the bear thesis that they might need to raise capital soon. If you have that much dry powder, you aren't going to be diluting retail investors anytime soon.
Right. It shows immense balance sheet strength. And strategically, it deepens their moat.
We talk about moats a lot, right? What protects them from competition?
Because everyone has an AI bot now.
Yeah.
I can build a chatbot in an afternoon. What makes Rezolve so special?
True. But Rezolve is building what they call agentic commerce. This isn't just a chatbot answering questions like, where's my order? Or do you have this in blue?
Okay.
This is combining commerce media with AI payments. It's the ability for the AI to actually execute the transaction.
So it's the difference between a travel agent showing you a brochure and a travel agent actually booking the flight, confirming the hotel, and charging your card.
Exactly. Imagine you're on a retailer site. Instead of clicking through 10 pages, the agentic AI does it instantly. Get me that jacket in medium? Done. Paid. Shipped.
That's powerful.
And when you have 51 billion API calls powering that kind of interaction, that creates incredibly high switching costs. If you're a retailer integrated into this system, you are not going to rip it out easily. The network effects protect their market share.
So they have the check, they have the cash, they have the growth targets.
Yeah.
But let's look at the chart. Because if everything is so sunny, why is the stock sitting at $2.59?
That is the million-dollar question. Or in this case, the billion-dollar question.
The price action has been brutal recently. We're looking at a nearly 30% decline over the last 30 days.
And just the other day, it dropped another 4.1%. If you're just looking at the one-month chart, this looks like a falling knife.
It does. It looks scary.
It does look scary. In the short term, I won't sugarcoat that. But you have to zoom out just a little bit. Context is everything.
Okay.
Despite that monthly drop, if you look at the 90-day returns, the stock is actually up about 20.1%.
So we are just seeing a pullback after a major run.
Exactly. It looks like consolidation near support. The market ran it up, and now it's digesting, specifically digesting that acquisition news.
Right. Whenever a company spends that much money, even if it's cash, the market gets a little jittery.
It wonders about integration risks. It wonders if management is getting distracted.
But the volume tells me something is happening here. I'm seeing momentum alerts going off like crazy on my terminal.
There were 38 momentum alerts triggered recently. And the volume is elevated about 1.15 times the 20-day average. We're talking around 31.3 million shares.
Okay, let's play market psychologist for a second. What does it mean when price is flat or drifting down, but volume is high?
It often suggests a basing pattern. It means shares are changing hands from weak hands, people scared by the volatility or taking quick profits, to stronger hands who are accumulating.
So the high volume suggests interest is high, not that people are fleeing.
Exactly. If everyone was just selling and nobody was buying, the price would have collapsed much further. This looks like accumulation. Institutions are stepping in and picking up the shares that retail is dropping.
And before this recent pullback, it was showing some serious relative strength.
It was. It traded above its 200-day moving average of $3.22, and it reached as high as $4.01 before the guidance came out. So the capability to run is there. We know it can trade at $4.
It feels like a coiled spring. But let's look at what Wall Street thinks, because usually when a stock drops 30%, the analysts start downgrading it to hold or sell to cover their backs.
Of course. No analyst wants to have a buy rating on a stock that's tanking.
Are we seeing that capitulation?
Surprisingly, no. There's a massive disconnect here. The stock is at $2.59. But look at the price targets. Alliance Global did cut their target slightly from $14 down to
Oh
$13.
no, a $1 cut. Stop the presses.
Exactly. It's a rounding error. They maintained their buy rating. Then you have H.C. Wainwright. They just reiterated their buy with a $12 price target.
So let me do the math here. The stock is under $3. The analysts are saying it should be $12 or $13. That's a, what, 300% to 400% upside from here?
That is the consensus. We had about 7 to 9 analysts covering this, and they have a strong buy rating. The street believes the sell-off is unjustified.
They're looking at the fundamentals, the revenue, the cash, the acquisition, and saying the market is wrong.
They are, and that is rare. Usually the analysts chase the price down. Here, they are standing their ground.
And the new sentiment backs that up.
It does. Overall, new sentiment is rated neutral quantitatively, but if you actually read the reports, the undertones are very bullish, all driven by that reward acquisition.
So the market perceives the deal as a real strategic enhancement.
A huge one for their AI commerce and banking capabilities. It wasn't a frivolous purchase. It was a strategic lock-in.
What about the big money? We talked about the $250 million in commitments, but are we seeing any Form 4s or 13Fs?
We haven't seen a specific cluster just yet. Sometimes there's a lag there. But that secured $250 million commitment is effectively a proxy for institutional accumulation. You don't commit that kind of capital if you aren't bullish.
You don't sign a $250 million check on a whim.
Not at all.
Okay, so we have the setup, we have the undervalued price, the strong balance sheet, and the analyst support. Now, what triggers the move? What strikes the match? What's on the catalyst calendar for the next 3 months?
A few key events. First, obviously, the earnings watch. We need to see the full 2025 results confirmed. But the real key, the main event, will be Q1 2026.
Why Q1?
Because of that 10x growth target. Investors are skeptical. They are going to be watching Q1 like hawks. They need to see if the revenue run rate is tracking toward that $350 million path.
So Q1 is the prove-it quarter.
Exactly. If they print a Q1 revenue number that suggests they're on track, say, 60 or 70 million, the skepticism will evaporate instantly. The stock likely re-rates rapidly to match those analyst targets.
And what else?
Then you have strategic events. They are participating in the NRF, the National Retail Federation 2026. Retail tech is huge right now. That's a massive stage. And they are rolling out a new SQD revenue model.
That could be a sleeper catalyst. If that new model increases margins or adoption, that changes the math significantly.
And don't ignore the macro factors. We are in an AI commerce boom. Money is rotating into stocks with strong guidance, specifically those doing non-dilutive M&A. Rezolve checks every single one of those boxes.
The market is hungry for AI plays that actually make money, not just promise it.
Precisely. And there's also a rumor floating around about the reward integration. It's speculative, but the talk is that it will accelerate an AI-powered banking innovation product.
That makes a lot of sense. Loyalty points are essentially a global currency. If you can make them spendable via AI agents, that's incredibly powerful.
It unlocks billions of dollars in value that's just sitting in people's airline and credit card accounts. It turns points into cash via their platform.
But, I have to play devil's advocate, we can't just drink the Kool-Aid. What's the bear case? Why did the stock drop 30%? There has to be fear there.
It's a fair question. The volatility is real. A 29.6% drop in a month hurts. I don't care who you are. And even though the analyst cuts were small, they were cuts. The market hates uncertainty.
And the execution risk has to be massive.
It is massive. We cannot gloss over that. Scaling from $40 million in revenue to $350 million in 12 months is an operational nightmare. Things break when you grow that fast.
Customer support gets overwhelmed, server loads spike, sales integration gets messy.
Exactly. It is incredibly difficult to manage that kind of hypergrowth without stumbling. And the current market cap, around $1.31 billion, it demands they hit these targets. If they miss, the stock will get punished severely.
So the risk is that they stumbled on their own ambition. They set the bar so high that anything less than Olympic gold looks like a failure.
Yes. However, that risk is significantly offset by the fact they're already profitable and they have that customer scale. They aren't starting from zero. They have the 650 enterprise customers. They just need to expand the usage.
So they're turning up the volume on existing clients, not just hunting for new ones.
That's the idea. It mitigates a lot of that risk.
Okay, it's decision time. We've looked at the growth, the charts, the sentiment, the risks. What is the final verdict? What's the smart wealth score?
I am giving Rezolve AI a bullish score of 8 out of 10.
An 8 out of 10. That is strong.
Yeah.
Walk us through the elevator pitch. Why does this belong in a portfolio?
It's simple. Rezolve AI is positioned for explosive growth. You have a $209 million ARR base and a clear funded path to $350 million revenue in 2026.
And that acquisition.
The $230 million non-dilutive acquisition of Reward was a massive flex of financial health that I really believe the market hasn't fully priced in yet.
And the price is just disconnected.
Completely. With the stock at $2.59 and analysts targeting $12 plus, the risk to reward is skewed heavily to the upside. The technical basing suggests the selling is exhausted.
And the moat.
And fundamentally, their agentic commerce infrastructure provides a multi-year moat. This isn't a trade for a week. This is a multi-year hold into that 2026 revenue inflection. You're buying a company that is profitable, growing at 10x, and trading for peanuts compared to its peers.
I love that. It's rare to find a company with this kind of growth profile trading at this kind of discount. It feels like one of those moments where we'll look back in 6 months and say, how did we miss that?
It really is. It's a disconnect that usually doesn't last long. Eventually, the numbers win.
So here is the final thought I want to leave you with today. If a company can spend over $200 million in cash without borrowing a dime or printing a single new share while projecting 10x revenue growth, why is the market letting it trade under $3? Is this a trap, or is this the opportunity of the year?
That is the question you need to answer for your portfolio, but the data certainly points in one direction.
As always, thank you for tuning in to Smart Wealth with Joshua. We hope this analysis gave you some clarity on Rezolve AI.
Make sure to do your own research, check the filings, and don't just take our word for it.
Absolutely. If you enjoyed this breakdown, hit that like button and subscribe. We'll see you tomorrow for another session. Stay smart out there.